Let's get some markets perspective now with Jason Schenker, who's the president and chief economist at Prestige Economics, who's joining us out of Tokyo. Jason, great to have you with us. And, you know, we start off the year, as we were talking about in the commercial break earlier, there is so much going on, be it, of course, a lot of these events happening in the US, a lot of the uncertainty going into the Trump presidency, and you know, crises in parts of Asia as well, right? How do you sort of navigate that uncertainty, even just on the first couple of days of 2025?
Yeah, these are great questions, Heidi. I think the most important thing right now to consider is there's solid economic tailwinds for the United States and for the global economy. We're in an environment where interest rates are poised to move lower. That's all very positive, but the biggest risks looming both going into 2024 and now going into 2025 are geopolitical and political risks. So I think we have to acknowledge those risks, but also look at the realities of a series of central bank policies that are likely to result in lower interest rates in the year ahead, more positive growth opportunities, and even though we see trade restrictions and tariffs as posing risks, there are going to be opportunities for winners in those environments as we see a further decoupling of dual use and technology supply chains from the U.S. and its allies, decoupling that from China.
So when you take a look at the risks for Korea, we've gone through just some of the immediate challenges, and a lot of the hope for a market like Korea is that, you know, in the medium term, perhaps you can kind of replicate the success that we've seen for Japan. Does this make the outlook a little bit murkier?
Well, I think there are two pieces as we're looking at the Korean outlook, right? There's the near term with the political risks, something that could further weigh on the Korean won, something that could impact how the Bank of Korea thinks about interest rate moves in the year ahead, and what even the growth outlook is in the near term. But in the longer run, the ICT industries in Korea are an important pillar of how the U.S. and its allies are planning to resist and decouple technology supply chains from China. So there are a lot of opportunities there for Korea. I'm very optimistic about the South Korean economy. And of course, look, I'm based in Austin, Texas, where we see Samsung expanding their chip manufacturing facilities. Again, you can see, I see it on the ground as Korea is becoming an ever more important part of that technology supply chain and decoupling from China. I think Korea is poised to be a big winner for that.
And of course, you've spent a fair bit of time in Japan this year, including your most recent stint. How's that sort of informed your view of that market and where you could see the opportunities this year?
Yeah, I think there are a lot of opportunities for Japan. I think obviously right now the very weak Japanese yen has been very positive for Japanese exports. And by the way, all these conflicts and challenges in Korea, weak Korean won is also positive for a country that's exporting high-value ICT products. That weak Japanese yen, very positive for Japanese manufacturers, very positive for Japanese ICT exports, also very positive for Japanese tourism. But in the year ahead, the Bank of Japan is looking to raise interest rates, however modestly, while the Fed is likely to cut interest rates. Our base case scenario is 3 interest rate cuts this year. That means that the Japanese yen is likely to strengthen a little bit against the dollar because those central bank policies are likely to move in opposite directions. But the Japanese yen is likely to remain relatively weak, which is something that should continue to be supportive of growth, especially with an exports focus for those high value capital goods, manufactured goods, and ICT technology products.
And of course, when we talk about sort of the Asia tech complex, we've got to look at the likes of Taiwan and Greater China there as well, right? Do you kind of expect to see that bifurcation? Where do the opportunities look compelling for you in that space?
Well, I think this is the big question mark here is how long does it take before a kinetic conflict between China and Taiwan becomes imminent? And I think this is the risk that a lot of countries and corporate executives, institutional investors, they're trying to balance. When does the saber rattling potentially turn into something like a more permanent blockade, which is we saw those joint sword operations 2024A in May of 2024 and joint sword 2024B in October of 2024. When does that kind of situation where Taiwan gets surrounded by China's Navy, the biggest Navy in the world, when does that become a greater risk that they surround Taiwan and stay for a protracted period? This is the big risk that everyone's trying to balance. In the near term, of course, there are opportunities for Taiwan, a critical economy for the global supply chain, for technology products, for chips and the like. But what happens if we end up with a kinetic conflict? That's the big risk. This is why there are such big opportunities for Korea and Japan in the years ahead as that risk becomes a greater probability event going forward.
Jason Schenker is the president and chief economist at Prestige Economics. Do stay with us. Lots more to talk about, including, of course, the outlook for the Fed. I'll get some more perspective now. Jason Schenker is still with us, president and chief economist at Prestige Economics, who's with us out of Tokyo today. So, Jason, you say that some pretty significant shifts in expectations on the Fed and monetary policy could happen over the next 3 to 4 months. Is that with or without the impact of whatever we see from the trade and immigration and fiscal policies of a Trump administration?
Yeah, so this excludes what we might see with the tariff and trade and immigration policy expectations. Just looking at what is likely to happen with things like the CPI data alone could drastically shift Fed expectations over the next 3 to 4 months. Basically, if you look at the historical data and where we're likely to see CPI come in for the next few months, base effects could send CPI for December, which will be out on January 15th, up higher on the year-on-year rate. In other words, we'll go probably from 2.7% up to 2.9, maybe even 3%. That's definitely the wrong direction that people are going to want to see, right? An acceleration in that headline CPI. Core CPI could accelerate from 3.3 to 3.4, also moving in the wrong direction. And then the result would be that you have a pricing in of fewer rate cuts than we already see. We saw those drastically reduced in the December FOMC projections, where an expectation of 4 rate cuts was reduced to 2. We could see markets price in maybe only 1 rate cut following that CPI report. That could strengthen the dollar, weigh on equities, weigh on bond prices, send yields higher. So you could have a number of different things happen. And as a result, what we could also see is the CPI come in a little bit weaker going forward, though, in the second quarter, where we think the headline CPI number could be below 2%, maybe even flirting towards 1.5%. The result of that would be the opposite impact, where suddenly people are pricing in multiple Fed rate cuts. We go from expectations of maybe 1 or 2 back to 3 or more, and suddenly the dollar weakens, equities rise, bond prices rise, bond yields fall. So you could see this swing in the markets where you could get over the next 4 months that little kid soccer team of expectations runs to, oh no, the Fed won't be able to cut rates, to, oh no, they need to cut rates a bunch. And that's something that could happen in just the next 4 months, excluding what we might see from policy expectations.
What does that mean for broader commodities? For gold, for example, we're still seeing that continue to advance even after, what, a 27% annual gain last year?
Yeah, I think for gold prices, obviously, if we get a stronger greenback on a CPI number that's going to be a little bit higher than expected, we could see gold prices come under a bit of pressure. But if in Q2, by the time we hit those March, April CPI reports, if we're between 1.5% and 2%, gold prices could rise on expectations of more Fed rate cuts. For industrial metals prices, they're going to behave probably a bit more like what we'd see from equities and from bonds, where if we get that stronger greenback on more inflation in Jan, then you're going to get, with that release on Jan 15th, the December numbers, you're going to probably see ferrous and non-ferrous metals maybe come under pressure here at the beginning of the year. But in Q2 and beyond, there's more upside. And there are expectations, as we see interest rate cuts across the global economy, that industrial metals prices could end the year significantly higher than they are now, because global manufacturing is likely to see upside.
What are your assumptions on the US dollar then?
Yeah, the assumption that we have going into this year is we're going to end the year weaker than we started the year. It'll probably still be relatively strong against most currencies, but because the Fed is likely to cut rates, and we expect 3 rate cuts this year because of these swings in inflation, whereas right now most are pricing in 2, mirroring the Fed's December FOMC projections. We get more cuts than people are expecting. If they're expecting 2 and we get 3, we get a weaker greenback by year end than we started the year. That's something that will reverberate across economies and be more supportive for things like the Japanese yen and even the Korean won, especially once we get past these political tensions that we see right now. There's more upside for those currencies by year end.
Jason, always great to have you with us. Jason Schenker, who's a president and chief economist at Prestige Economics.